Hey guys, this is Julie. I'm got a treat for you. I've got a guy who's an active trader. Alex is with us, and we're going to go over a little bit about what happened last week with the VIX, that massive GEX exposure on 15 strike, and see what he thought about it, and have questions how that relates with JATS. How are you, Alex?
I'm doing well. Good morning. Happy
Hey.
Saturday morning, everybody. Yeah, no, I thought it'd be fun to jump on here, and I just had some questions for Julie, so we figured we'd record it and and distribute it to everybody else in case everybody's looking to learn and get better at utilizing this tool set.
Yeah, it's good. It's good training. I mean, the question is so relevant. It's like, how do you use a real world example of having, an outsized, massive event happen? How do you get a benchmark to, set up your knowledge base to know how to handle that in the future? So tell us what you have on your mind.
Well, I've been following you for a while, but I really started to dive deep when I was really noticing the effectiveness of your levels, and I just kind of wanted to circle back and maybe start from the beginning with a couple things like what exactly are the JATS PT levels and how do they define price movements for the week?
Oh, okay. Yeah, sure. Well, they're proprietary price targets, PT for price target, and they are based on this variance-based model that forecasts expected market movement. So unlike a standard deviation or Black-Scholes, JATS price targets directly measure price variance and range expansion. So they can provide key levels for your expected price containment zones or critical inflection points like this weekly one that pinned that 15 VIX with that massive 70 million contract GEX last week, Friday. Show you this. It did get up to 70 million, almost 68 something, almost, yeah, 69, 68.5 million. And then it snapped back. And as you see on bar chart, it finally came back to about 30 million. Um,
Yeah, I find this like so interesting because I trade ES and NQ pretty much every day, and I'm watching it throughout the day, and sometimes you'll hear about, different changes in the gamma structure or different behavior of the market makers or the large traders. And yeah, I was just really, really interested to learn more about, how this kind of maps out what the market makers are doing and how this can help kind of find actionable levels to, to utilize during the day.
yeah, we've, really zeroed in that market makers use these key liquidity zones where the dealers and the large traders will adjust their positions. So, like the weekly one, or the monthly one, or quarterly one, because that is your first standard deviation going from the mean to the three. So, the mean is in the middle. The 1 to 1 is like the first standard deviation. And let me clarify that JATS does not use standard deviation. Okay.
Mm-hmm.
We have a proprietary model that uses realized volatility, but um, just it's like demonstrative of what standard deviation is like around that distribution. So if you're going from mean to three, it's like 34, 68, and 95. So that would be your zero point 0.5, 1, and 1.95 of your standard deviation. But we're using our own proprietary calcs. So
Yeah, so the levels themselves are basically like if you anybody that took a statistics course, these are different levels that are displayed around the bell curve or the curve, and
on a time-based model, correct? So that,
right.
something that we've noticed that is often representative of how the dealer interacts with the market. The both the ES and the SPX, as well as the VIX, adhere to these type of market structures. So that was the VIX on the weekly on that 15 that captured that
Hmm.
GEX that they were pinning. That took them 68 million to keep the market from rallying, the VIX from rallying and the market from falling. Um, so,
Yeah, what I find interesting is even in between the levels, you can kind of see a magnet or a price action behavior that's expected. If you go back to the previous one, it's bouncing off the low levels of, I guess you call it gamma levels or different exposure levels, and then it kind of drifts towards the mean, like you said. And I notice that now when I watch this throughout the day, you can see it kind of spike there towards I guess 1662 or something around
mhm,
that.
mhm, mhm.
And yeah,
Yeah, absolutely. It bounced off of the first time it hit this weekly one, went right back to the mean and flattened out. Sort of did that little stop run, volatility stop run, and came back to test that 15 again. And, any bit of volatility, we're in a new week here, so you can see the distribution has shifted, and you're right now in the middle of that. So your first easy profit target to get to for the week could either be, 1347, 1308, or 1623 to 1662. And so that will get us in frame, our market in our head for next week where we could possibly go inside a daily framework that
yeah, I
extend.
love the way you describe that daily framework because when you're looking at these levels and you kind of understand how they're oriented, when price moves away or towards or it reacts with these levels, it's really defining like a behavior of the market makers collectively. And so to me, this is just so fascinating that it's basically explaining what they're doing by looking at these levels in a way. Do you agree?
Absolutely. Yeah, no, that's a really great way to state it. I mean, the market is very algorithmic, and so once we tapped into the framework that they're trading in, we can, have a football field and plan for the edges. Doesn't mean it's always going to hit the end zone, right? So
Mhm.
if it's high, medium, or low volatility, we can plan to go to one, two, or three on these various different time frames, or to extend outside and go to 1.5, 1 3/4, two time the range, right? So you
Yeah.
can extend out, and as far as you want to go, you can go Six Sigma out if you would like to, but um, usually within this 1.5 to two times the variance of that range, daily range in this instance. But you can go back and see historically what how the market has stayed within the
Mhm.
daily, weekly, monthly framework, and when it gets to an edge, that's where it will respond back inside.
So yeah, I actually have a question about that. So as the price moves towards the outer levels of the framework, would you say that there's like more gamma effect on it, or you know, is the effect expected a more drastic effect?
Yeah, that's a great question. It can often signal where the gamma increases or decreases because it is trading either near a weekly two, which represents 68% of the range, and that often will give you the gamma that they're going to be parking their gamma at, so that they can get that adjustment. And that weekly two is the expected range, right? So when we put their implied volatility assumption on any given day with the black shoals, which is um, different than the realized volatility, we're showing you what the dealer's realized volatility support resistance is likely to be. And so you can get that spread if you want. If you're going to sell premium, you can see where their implied vol levels are in relation to this. and realize the significance, of the 68% daily two or weekly two or monthly two. You can see how it
Mhm.
interacts with these levels. And then if the gamma itself is negative or positive, then, like I said, you can see that the dealers hedge in a way that suppresses volatility if it's positive or increases volatility if it's negative. Force selling into sell-offs and buying into rallies on that negative gamma. So you get more range expansion when it's a negative gamma. And that's why having just that knowledge of what the overall gamma is going to be on a daily basis, as well as the overall GAX, which means all contracts, got up to 68 plus million contracts on Friday, which is massive. Massive. That's very rare. So,
Yeah, that's just I think one thing I didn't really realize before is the dynamic nature of the gamma levels. I mean, they're technically adjusting all the time, but you can see how the levels shift and morph from the day-to-day basis. And I think
mm-hmm,
that's a really important thing to point out because as I watch the market, I kind of have this framework where the market trends for a while, and
mm-hmm,
then it rests and it compresses.
mm-hmm.
And I was just wondering if you can kind of talk to that and maybe show a couple of examples on maybe ES or Nasdaq on what happens when you get these transitions from trend to compression.
Oh, sure. Sure. You get that range expansion and contraction. A good way to show that is using a daily bar. So I'm going to put this over here on the monthly range. And let's switch back to the ES because I think that's easier to see. VIX doesn't move around that much compared to like the ES monthly. Um, so you can see here we got up to this monthly one
Mm-hmm.
at 61.49 where it's stalling out between these two monthly lines. And you can see the bars very little in comparison to this giant bull bar there.
Mm-hmm.
But we got right up to the resistance, which is a JATS PT monthly level. We can measure 4 weeks, we can measure 30 days, or we can measure the number of actual trade days in the month, and also on the open and close. So we've got you covered on, identifying like where these confluences are. There was a couple of confluences right here around 61.49, 61.50. But when you look at the oscillator, this is where the magic comes in. So your secret sauce really is how the current realized volatility is interacting with the historical volatility,
Mm-hmm.
and whether that historical volatility is the slope is compressing or expanding. So right now you've got a flat range showing um, the contraction in the market is
Yeah, it's
happening.
trending downward. It's also at a low point, so
Well,
it's
it's low volatility and
mhm.
flat versus an expansion is a little bit more slope. That's your skew. And then the realized volatility is giant. So you can see that the daily range actually went up to these blue lines up here, which are, I've got weekly and monthly blue lines up here.
Those are pretty extreme
Well, it's
levels,
showing that one, well, you can see how big that bar was.
right?
Right, right. So,
So relatively, that was a very large move, and it kind of tapped out at the boundary.
yeah, 209.50
Mhm.
and 234. So it went to the volatility level. I mean, that's what I'm trying to get you to like focus in on.
Right.
So it trades to the actual volatility for that specific range that day. And on this day, on the big market sell off, that one daily range traded up to the 30-day
Got it.
two, which is huge when you say, well, I want something to, write down in my book. Will the market trade to a 30-day two? Yes, it will. And what does that look like? Here's your 30-day two right there on your screen. So I'm matching the point range to my level.
So I really like the daily point of view for a couple of reasons. I think in a lot of methods that I've learned and studied, it's kind of like a top-down method. So you look at the daily or monthly, daily, weekly, and you kind of get a an overall synopsis of what their market's currently in, maybe its state,
Yeah,
and
yeah.
then from that you can formulate how to make trades or how to plan trades during the day. So I think that's important, is to kind of like start at the high top of the mountain here,
Hmm,
and
hmm.
kind of learn to read, what's going on at the high level, and then that can basically affect how your strategy is on the lower time frame.
Right, right. The market mainly stays inside the ones.
Right.
So the dealer's delta neutral because they're protecting their portfolios, they're protecting their institutional clients' money.
Hmm.
They don't like having to hedge and buy, puts or sell
and
puts.
they get more
Right,
aggressive
right, right,
the
right.
closer to the boundaries, right?
Well,
Yeah.
and once in a while you'll get a big break of the daily one with huge, volatility for that one day.
So it's
And
safe to say they're going to step in and make some course correction or some action,
mm-hmm, mm-hmm.
because their inventory is at risk at that point.
Right. So they've had to go ahead and that negative gamma came into play.
Hmm.
Remember we were talking, is it positive gamma that's more supportive of indicating that it would turn around and go back to the mean? Like right here, got up to the target. It was that dual wapiti
Hmm.
of the two, the monthly two and the monthly one. So, um, and then it went back to the mean because it was probably positive gamma. But here, definitely it broke, and chances are that was negative gamma when that happened. So if you have an understanding of your gamma structure, then you know where the levels are that they're probably going to be. This is all probability stuff.
Yeah, everything's always
Right, right,
probability.
right.
Nothing's a certainty,
Nothing is certainty, but
but I
and
love this as a
past
planning
performance
tool.
doesn't these
Right.
are screenshots, and let me give you the hypothetical disclaimer
Hmm.
here. It doesn't mean that just because it happened before it will happen again like that, but we have to have some sort of benchmark and football field and probability in our checklist.
Hmm.
And so when we can, correlate our support resistance levels with the JATS model with gamma, it's a very solid structure. And I have found that the gamma models that I'm getting with Quick Strike are excellent to work with. So I use Quick Strike option analytics tools. Highly recommend it.
Well, my last question today is kind of like on this daily time frame. Say, we're talking here on the 15th of February, and say the end of the month comes around, and the whole structure ladder of the levels has shifted upwards into next month. Now, would you potentially take away from that that the dealers have moved to a more bullish position, that they expect the market to go up, which is why they've reoriented their options inventory to be a little higher than last month's?
The dealers will definitely have that put call ratio bias. If there's a
Mm-hmm.
bit of a separation there between the two, can impact price, your future price for the implied volatility and how your implied volatility is, printing with your premium. And the options can give you an indication of, expected future volatility. But I'm sorry, what was the question again? I've got lost.
So like we're looking at February here, these levels that will plot for the month of February, and say, March comes around and the whole structure of all the levels has shifted upwards or downwards.
Okay, well, that's a great question. So, how would you know if we're at the end of February where it's going to go? That's a great question.
Right.
Well, we can give you that information. It's right here on your monitor. These are actual point ranges. So, you could pick, if you wanted a 30-day range or a monthly range or a 4-week range, which point level that's going to be for 1, 2, and 3. And you
Mhm.
can actually run that from the close on the last day of the month before you get your print on the open of that trade session
Mhm.
to know exactly where your next month's levels are going to be, or the
Right.
next week or the next day before you get your print if you wanted to do some rough off the pencil calculations. The point range is right here. So it's points and levels. You will give you the point range, and then we place them from either the open or the close. And so you can get that new um, distribution for the period of time that you're interested in and do some calculations with your momentum, your moving average or your RSI, whatever you like to show you VWAP, your system for identifying trend, which is so ubiquitous, right? There's a million ways to define it.
Right.
But whatever method you currently use, this works great with volume profile. There's so many different, VWAP works great with this system. So this gives you your end profit target. How you get there and which side it's going to be on can be a version of gamma and trend and momentum. And it doesn't have to be any more difficult than that. So you can put a 14 SMA on here, have a little gamma knowledge, and pretty much understand what you would like to do once you get to a level. And especially when you see this realized volatility hitting one of these key statistical levels,
Hmm.
you do you see how often it responds?
Oh yeah.
I mean, this is not coincidence. Here we got a little bit of an overkill, and look, it came right back in because the volatility came back. Usually, will always come back to the mothership because the professionals wait for these sell the rip by the
Right.
dips.
Well, that's a really good thing to highlight. I think I'll probably have questions about that next time we do this. But I'm going to be watching next week, and I'm going to continue to learn, and
Super.
I'll probably bring you some
Yeah,
more
stick
questions
around.
for
Stick
another
around. We'll have
time.
to do this again
Yeah,
soon.
absolutely.
All right. Well, thank you so much, Alex, and appreciate all the good questions. Can appreciate it so much. We'll talk to you guys soon. Um, thank you.